All right, 15 minutes till market open. We're trading NQ micros. Firstly, I'll make note of the indicator I have. It just shows previous day high, previous day low, previous week high, previous week low. Those are just key liquidity levels that price will want to react at, whether it's to the buy side or sell side. That all depends on, where price is currently at, what your bias is. But I have those, and then when you're on the kind of 30-minute, 1 hour or below, you will see the other indicator that also pops up. And those are the overnight session high and low. So specifically London high and London low, which is where price will also want to react. For example, London low was here, candle came down here, swept out London low, we went bullish. Not necessarily the case that will always flip, but that's just an example of price kind of reacting at those key levels. We'll start on the 4 hour, or let me just look at the 1 day and 1 week to explain that. We are at all-time highs, and when we're at all-time highs, it's not smart to short, right? I think since we've been at all-time highs, which has been, it's been about a month, and since we've been at all-time highs, I've taken 2 short positions, one of which I've won, one of which I've lost. So 50% on shorting all-time highs, that's not good. Ideally, you want to long, trade in the direction of the trend. The problem with that is that most people, let's say when they think they've just broken all-time highs, that it's time for the market to pull back down immediately. That wasn't the case for like 2 weeks, right? So stop expecting the market to pull down. Don't predict the pull down. Wait for price to pull down on a somewhat of a lower time frame, even 15 minute, 5 minute. Wait for it to pull down and then take longs, trading in the direction of the trend. That is the smartest thing to do in all-time highs. So you can see we're at all-time highs on the 1 week. And we got the 1 day, same thing. Now what I'm going to do is mark my high time frame confluences. So those will be fair value gaps, order blocks. Really, that's about it. If I see any trendline liquidity, any buy side or sell side trendline liquidity, I'll mark that as well. And, potentially breaker blocks, mitigation blocks, stuff like that. Start on the 4 hour. Immediately I see a 4 hour bearish fair value gap. So I'll just draw it out here. Mark it. See another one right here. Now the one with the bearish fair value gap right here, this is another concept that I'll kind of explain real quick, is that we had a bearish fair value gap right here, but it was successfully tested on Friday, right? Now, just because it was tested doesn't mean there's no more selling pressure in this zone right here. Because what happens is, like, let's assume there wasn't a fair value gap here and we just saw this high, and this high is a lot clearer to read. Like, let's say if we were to go on the 15 minute, you can see the high right here. Naturally, if we didn't see a bearish fair value gap here and we take out a high, what moves the market? What drives price? Liquidity, taking out major highs, major lows, minor highs, minor lows, any internal liquidity, any external. This would count as internal liquidity, and it's clearly a high that if price were to take it out, sure, we might not immediately flip and take out these lows. It's not that it's going to look like that, but it might look like that, just a temporary pullback as we were continue bullish. The point I'm making is there is selling pressure just based off this high. So if you look in this specific context, we not only have this high, but we have the bearish fair value gap as well. So those are 2 confluences that can drive price down. That is much stronger. That is enough for my first example to play out, where if I take that arrow and we take out those highs, we take out the prior 1 hour candle low or 4 hour candle low, or even previous day low. We see we have PDL right there. We take out PDL, or we even take out this major low, right? Those 2 confluences combined are enough to drive price that much. And what you would call this specific zone in this example, where there is a high or a level within a bearish fair value. So of course, for a bearish example, we're looking for highs, right? A high within a bearish fair value gap, you would mark this as an intermediate high. You would mark it as an intermediate high. So this is what it looks like. IM, that stands for intermediate. If we're in a bullish context, then it would be an intermediate low, of course, right? You just flip it. So we have an intermediate high within a bearish fair value gap. We have a regular bearish fair value gap right here, both of which are on the 4-hour time frame. Do we have any 4-hour confluences bullish? I don't see any fair value gaps. I don't see any order blocks here until we scroll all the way down here. I doubt that price is going to drive all the way down here. If it does, then we're probably going to change our position. Instead of taking longs, we'll take shorts. 1-hour time frame, what is that showing us? 4-hour and 1-hour usually are the best for me determining my bias, and that bias can always change, and we'll have to adapt depending on like which direction the market goes at market open. But right now, off the 1-hour, I see a bearish fair value gap right here, right? This is a bearish fair value gap. And now let's just imagine that I drew the bearish fair value gap right here. This is again an example of the intermediate entry. You see how I mark here IM, the highest point within that bearish fair value gap. What is the highest point within this bearish fair value gap? It's this candle right here. So I would mark this as an intermediate. And that tells me that even like price can continue bearish even if we don't cross this point. We still have selling pressure in this zone right here. We still have selling pressure. And what might make it easier for us to understand is that we don't go based off of there being an intermediate. We go based off there being an order block. And this is an order block candle. There's only 8 minutes till market open, so I'm not going to explain what makes an order block because there's a lot of parameters for that. But this is a 4-hour or 1-hour order block candle. Now we can just get rid of this intermediate. It's not that important. We want to make the chart look as clean and comprehensive for us as possible. The more information that we have that's irrelevant or redundant is just going to slow us down. So we have an order block right there. Over here, potential fair value gap after 37 minutes, but of course this can be disregarded. If price just pulls all the way down, then there would have never been a fair value gap. Let's assume that we are long. That we're bullish, right? We had this level here that I had marked last week, and this is an intermediate within this 1-hour bullish fair value gap. Also, we have a 1-hour inverse fair value gap right here. That price perfectly entered right here. So let's look at it again, right? We have an intermediate low within this bullish fair value gap. What's the lowest point within this fair value gap? Candle 1, candle 2, candle 3. It's this candle right here. We mark that as an intermediate low. So we know that once price sweeps that point, it might want to continue in the opposite direction, which in this case is bullish. Not only that, we have a 4-hour inverse fair value gap right here. It was initially a bearish one. Price slammed right through it, making this sequence inverse. And now that drives price long. There's a fundamental reason why. I'm not going to explain it right now, but it will drive price long. So as long as you can identify that that's an inverse fair value gap and you mark it, you know that it brings bullish momentum to price. So we have that. So now let's assume that price is bullish. We don't have to wait for another bullish confluence in the internal liquidity here because we don't see anything on the 1-hour or 4-hour right here. We don't see anything since 12 a.m. So now it's telling us that, okay, there might be something on the smaller time frame, right? Like 15-minute, 5-minute. So look, on the 30-minute time frame right here, which usually I notice that confluences on the 30-minute and 15-minute coincide. Like what I see on one, I'll see on the other. So I have a 30-minute bullish fair value gap right here. Let's look at 15-minute. Boom, 15-minute bullish fair value gap right here. So I know that there's buying pressure in this exact zone. Not only that, I will mark this one right here. It is a 15-minute bullish fair value gap. And not only that, once the 30-minute time frame ends in 5 minutes, once 9:30 opens, there will be a larger one right here. So that is something that could potentially drive price bullish. Let's see. That's all I'm seeing on the 15-minute and the 30-minute. Technically, this is an intermediate right here. I will mark it. I know that if price takes out this, we might want to continue bullish. It's also just like a clear liquidity level. It's a clear low. It's a very clear low that's resting below London lows. That's confusing us. We don't need that. So intermediate low resting below London lows. We have previous day low right here. We have a 30-minute bullish fair value gap right here with a 15-minute inside of it, and we have a 30-minute bullish fair value gap coming here as well. Yeah, all of these are bullish. Now this is where we've kind of covered the main time frames: 15-minute, 30-minute, 1 hour, 4 hour. 5-minute and below is when I look at for entries, right? That's where I look for when am I going to enter in the market. So we want to look for SMT divergences at this last point. Like right before we're looking for entries in the last 5 minutes before market opens, I look for an SMT divergence. Now SMT divergences can be on a high enough time frame like the one on the 4 hour, or it could be as low as the 5 minute, which is more relevant when we're trying to enter price. So on the 4 hour off rip, do I see any SMT divergences if we were to compare NQ and ES side by side? No. Looks in sync. An SMT is when one of the indexes make either a higher high while the other makes a lower high, or in a bearish context, one makes a lower low while the other makes a lower high. And what that means is that they are out of sync, and price is going to want to move in the opposite direction to find its equilibrium again. So that's what we're kind of looking for, because that alone, that SMT, can help us understand like when either A, a pullback is happening, or B, when we should enter our position. And you'll kind of understand like which applies for each case while I go through this. Everything looks in sync. See, everything looks in sync. I'm really looking for is one taking out the low while the other isn't. I don't see it yet. Let me look for 15-minute now on both time frames. Okay, this is the 2 p.m. Here's what I do. Here's what I want. I want NQ to take out this high while ES doesn't. That will tell me that price is pulling back down. That doesn't tell me that we're taking shorts, because why? What's the main reason? We're at all-time highs. We are at all-time highs. We are only going to trade long. Whether you see this indicator here say that we're bearish, that does not matter. We're at all-time highs. We're going to take longs. So when I see an SMT, a bearish SMT, I know that, okay, price is going to want to pull back down into a bullish zone. And that's when we will take our long. So since there's no SMT right now, I won't keep this side by side. I'll have it on another screen, so I'll still be able to tell when it's happening. And lastly, what I like to do is just mark any high time frame confluences on ES as well. And that just kind of tells me that if price reaches a certain point on ES, where is NQ at that exact point? And it kind of helps you in understanding the market direction. So I will mark my 4 hour bearish on ES. I see a 4 hour bearish. I don't see anything 1 hour bullish. It's about it. It's really about it. Yeah. All right. So I have it pulled up, and market's opening in 10 seconds. There is no major news that we have to worry about. So really right now we're just waiting. do have a 1 hour bearish order block right here. I like to see SMTs. That is what I love to see. Volume is pretty low. Volume is very low. Only 8,000. Like, here's the thing. I've marked this bullish, but I don't know if I would take the trade. Because ideally, with my strategy, I want there to be an SMT divergence. And I want a deeper pullback, right? Like, we just pulled into this within the first minute of market open. That's not as reliable. Now we wait, pause, and then I'll be back. All right, ideally, this is where I'm gonna have to pull up ES. See, both of them on the 15-minute time frame. Ideally, I'd want NQ to take out or to enter this 15-minute bullish fair value gap while ES doesn't. That would be an SMT. It would look something like this. This candle number 3 from this fair value gap sequence, and then we get the wick of this candle down here. While on this end, the third candle of the fair value gap sequence to where price is currently at would look something like that. That is an SMT. That's a good SMT because it's an SMT entering a bullish fair value gap, right? And we know we want to take our longs. So this is something I'm kind of hoping for, that NQ enters this zone while ES doesn't. And, you know, that could happen, that may not. But if I see a confirmation, look, it's about to. If I see a confirmation in here, I'm going to take it. And then it'll just be best for me to walk through how I enter my trade when it happens. Senior Iranian source: the U.S. has shown flexibility in ongoing discussions, including over limits to Iran's nuclear war. All right, just some fucking Iran news. But all right, this is good. I like this. I like this fair value gap because it's not only a 15-minute, it's also a 30-minute. Minute time frame just ended. That's good. I like that. If we break this level right here, I'm taking longs because that would be an inverse fair value gap break of entry. Let's see. Now this is where, when I know that my trade is about to carry out. Okay, so we disregarded it. Is there anything on the 2-minute? Okay, then I'm gonna wait for the 30-second. In either case, this would probably be my entry point. 247. Let's see how many points that is, and then I'll know how to risk accordingly. That is 108 points. 108 times 2 is 216. 500 divided by 216. I'd probably want to risk about 2 micros in that case. 2.5 micros, that's really what it is. But in this case, we'll do 3. Still, this is looking great. This is looking great right now. Still kind of weak now. All right. Something that's telling me that price is ready to push up here is if you look at ES, where price didn't even pull down here, we've already got a high volume bullish candle coming. You've already got it. We've already got it. So that tells me that I'm looking for, I think, a 3-minute IFVG break. We're going to target a 1-to-1 ratio. Let's see. Yeah, we're gonna have to. We needed this 3-minute right here. Well, we've got a 30-second not far out, but I don't know. Wait for this candle to finish. Ideally. No, we're good. We got a 30-second. As long as I see so I have another. I have the actual Trade of 8 charts pulled up as well, and I'm looking for a 30-second. If I see a 30-second break, I know I want to enter. Don't see it yet. It's not bad, actually. I need the candle to finish. That is the best way to confirm that you want to enter the trade, is you wait for the candle to finish. Like, we're looking for a 3-minute inverse fair value gap break. So while this is finishing, let me explain how my entry works. We have a bearish fair value gap here. This bearish fair value gap on these 3 candles, candle 1, candle 2, candle 3, occurs after this SMT divergence entry within this 15-minute and 30-minute bullish fair value gap. So when I see the 15-minute and 30-minute bullish fair value gap, I know that I already want to enter long because there's an SMT created at that. Now when I want to enter, I just look for the highest time frame bearish fair value gap, which in this case is the 3-minute. I don't see it on the 2-minute and the 1-minute. I want to see that get inverted, meaning I want the candle body to kind of break close to the top, close to the open of the second candle in the bearish fair value gap sequence. So the second candle in the bearish fair value gap is this one. I kind of want the body to break above it. So it is doing that. I know it will by the time that those 30 seconds end. And we don't need to see ES anymore. We already know what's happening. So this is why we wait. This is why we wait. Look what's happening in price. That could be a bearish fair value gap right here as well. Until the body breaks above it, we do not enter. But now that we've got that, as long as price enters down here, if we take out this low right here and we enter this bullish fair value gap, I'd be okay with entering. We also have an EMA line that we're kind of resisting off of. I'm cool with taking my longs.
Order filled.
I'm cool with that. Now we're looking for a 1-to-1. Ideally, I mean, if we could just take out that high right there, maybe. I'm trying to think of like a good point. See, like clear bullish candle on the 1 minute, breaking in, and a 30-minute and a 3-minute inverse fair value gap break. I mean, that's perfect. That's all you really need to see, especially after an SMT divergence within the 15-minute and 30-minute bullish fair value gap. I mean, that's clear. And you're seeing ES pump. That's how you know to enter. Now, in terms of profit, the issue with this is that ES is nearing the top of this, so I don't want to create a bearish SMT divergence where ES has taken out of the high and this turns into a higher high for ES. Meanwhile, it's going to be a lower high for NQ since NQ is lagging a little bit behind. I don't know if I want to target this point up here. The smartest thing to target is a 1-to-1 ratio. So that's what we're going to do. Now the 1-to-1, I'm going to do it from here to right here. That's a 1-to-1. The low of this, of when price, you know, kind of the furthest price pulled down right here of when the uptrend started to a 1-to-1. And we wait. All right, ended up getting stopped out. Here, let me zoom in. All right, 1 minute time frame. I mean, you can see, took out this low where we had our stop loss. The second we swept this, we had like a pretty high volume bullish candle. I don't know if now we're gonna take out these highs. It's not impossible because even though we took out this low, we're still within this 15-minute bullish fair value gap. So we could have very well taken out that low, ready to move in the direction of the market. So look, that's a possibility. I think what could I have done better here? We're not going to enter another trade. But what we could have done better is I don't understand. I think the problem was ES, like when this SMT was created on NQ, ES took out that high shortly after. So when ES took out that high, ES was ready to pull back down because it just targeted its external liquidity, which were these highs. It just swept it, and then it pulled down, which we can see. Look how far down that wick came. So NQ is going to kind of replicate that to an extent, which is why I think we pulled back down and we took out this low. So maybe when I saw that ES was close to this high and that it had taken out that high, I shouldn't have entered my position, or I should have sold it at break even, and I should have waited for NQ to also pull down and get a more discounted entry.